Gold is the money of kings, silver is the money of gentlemen, barter is the money of peasants, but debt is the money of slaves. Gold is money. Money that has no flag and is not created by men. For the past 3,000 years, gold has been used as a protector of wealth, a hedge against inflation, and real money when all else fails. In the Middle East, Far East, and South and Central America, they still hold this view of gold. But in the West, we view gold as a commodity.
Has the bubble burst on gold or just taking a pause that refreshes?
The gold bubble has burst.
And I don't know that gold can hold on longer term to move higher.
It's a sign that gold, like dot-coms and real estate before it, has become a bubble, and it could burst.
And I think gold is headed back down to 1,000 for sure.
So what is it? Is gold money or is it a speculative commodity? There are three midterm trends that will drive the fiat price of gold to highs that Western economists can't even imagine. Central bank buying, movement away from the US dollar, and China. Midterm trends, central bank buying. In 2009, for the first time in 20 years, monetary gold, or central bank and investment buying, outpaced gold buying for industrial jewelry purposes. In 2010, China, Iran, Russia, and India's central banks were all significant buyers as they moved cash reserves to gold. Russian holdings stand at 756 tons. China currently has stated publicly they would like to acquire 6,000 more tons. Unofficially, they have stated targets as high as 10,000 tons. China imported 209 metric tons of gold in the first 10 months of 2010. This was a 500% increase. China, by the way, is the world's #1 gold producer. India, by Q3 2010, imported 624 tons. Movement away from the US dollar. On November 24, 2010, China and Russia officially quit the dollar and agreed to use each other's currencies for bilateral trade, including oil. Recently, China's President Hu said the dollar system was a product of the past. Last summer, McDonald's sold nearly 30 million in renminbi bonds to pay for new restaurants in China. The state of Utah is discussing possible legislation about having a currency backed by gold. Virginia has already proposed legislation to look into a currency alternative in case the Federal Reserve System breaks down. And last month, China increased the number of exporters who can use the renminbi to settle transactions from a few hundred to almost 70,000. China. One of the single greatest influences on gold for 2011 may be Chinese demand. Chinese buying, both officially and public demand, is a major trend going forward. Remember, the Chinese government respects gold. This is evident by the laws they have passed to facilitate mining and private ownership of gold. The government encourages the public to put 5% of their savings into gold. The Chinese see gold as a wealth-preserving asset. The former CEO of Newmont Mining feels that it will be buying from the Chinese public that will eventually propel gold prices into the stratosphere. However, in the West, governments encourage citizens to borrow, with special tax credits and deductions. The more they borrow, the better off they are according to the government incentives. The Western mindset on gold is completely different from the rest of the world. Gold in the West is treated as a wealth-gaining asset to be traded like stocks or bonds. This is one of the reasons Westerners are constantly fretting about the price of gold in fiat currency terms. There are also three irreversible trends that no one can deny: an aging population, outsourcing, and peak oil. The aging population. The baby boomers dwarf the generation before them and after, born between 1946 and 1963. As people age, they spend less, make less, and pay less in taxes. GDP and tax revenues are going to be reduced over the next decade, forcing governments to create more currency and further debase their fiat currencies. Outsourcing. Outsourcing has destroyed the manufacturing sectors in the West. The Chinese worker who built your iPhone made $287 a month. Western competition has all but been eliminated. As US workers lose more jobs, as factories move offshore, long-term unemployment will become normal, and inevitably GDP and tax revenues in the West will be reduced. Western nations will have to borrow and further debase their currencies. Peak oil. Peak oil is the point at which the maximum rate of global petroleum extraction is reached, after which the rate of production enters terminal decline. This has already happened in the US. In the next few years, Mexico will also become an importer of oil, and the US will lose its third largest supplier. Our fragile, highly indebted economy relies on this land-based cheap oil to continue, and it cannot withstand the shock of transitioning to more expensive alternatives. If China, which currently has 1/10 the number of cars per capita as Americans, was to reach par with the US, we would need 7 more fields the size of Saudi Arabia's to meet their needs. An aging population, outsourcing, and peak oil will all cause a further decline in GDP and tax revenue. Higher trade deficits, higher unemployment will cause the US to borrow even more, resulting in an even greater currency devaluation. As the world realizes that the debt crisis will only grow, that the West will choose to default through inflation, demand for gold will inevitably rise. Mine supply has been in decline since the year 2000. Fewer deposits are being found, smaller, lower-grade deposits. As safe haven demand accelerates, the world will turn to gold. If the world's pension funds and hedge funds move just 5% into gold, gold would need to trade for at least $5,000 per ounce just to meet demand.